Guys, I'm hungry, so I will not keep you too long in this video, hopefully, but I want to get into raising capital for your investment properties. I work with a lot of newer investors, whether they are working on their very first property or they already have like 1 to 3 and they want to start scaling. Structuring the deal or structuring the property before we go into the deal. How or what are your plans for the property really plays an important factor on how you can utilize and maximize the capital. So I always recommend looking to the BRRRR method: buy, rehab, refinance, rent, and remains. Force appreciation into your property, get a cash out refi, and hopefully you can take out the majority of your down payment when you do the cash out refi. It is one of the clear and concise ways to do it if you do not have a lot of cash. And it's how you're able to scale very fast when you can just start recycling your money. The rehab doesn't have to be huge. You may be able to, let's say you find a 200K property, hopefully off market. We'll get into that in a second. And okay, it needs a 30K rehab and it can appraise for 280, 290. Most cash out refis, they're given 80%, so you could pull out a good portion of it. The next one, creative financing. I know people don't like to hear it, but it is an option as well. There's a ton of different creative financing options, sub-twos, seller financing, wraparounds, but I want to talk about assumable loans. Assumable loan, you are assuming the seller's loan, so you're assuming the terms, you're assuming everything. A lot of times when you do hear about an assumable loan, they are talking only about you get the interest rate, get the low interest rate, which is amazing. But you have negotiating power when it comes to the down payment. A lot of times the seller is going to want the down payment to be the equity that they have in the house. So it could be high depending on where they are in their loan. But if you caught them early, the down payment could be pretty low. There was a scenario where the seller needed to sell the home to purchase another home. So the negotiation power was definitely in the buyer's hand. So they agreed to assumable, lower down payment, and it was good to go. So low interest rate, low down payment, and hold on to that property forever. Now, another one people don't like to talk about is the credits. We'll talk about revolving credit first, right? That's a little bit lighter. If you already have a home, or maybe you have a property, we'll talk about a primary home first. Tap into a HELOC, tap into the home equity line of credit. I know somebody right now, his home is almost paid off and has never touched a HELOC. It's like literally sitting on 300K in equity, never touched it. I'm like, you are playing. If you have your business set up, if you have your LLC structured, you have your small business, tap into your revolving business line of credit. Now, I know, guys, I get it. Tons of videos that are out getting business credit cards. I get it. And I know where the negative connotations come from that. But when you have a plan, you have an exit strategy, you have your goal, utilize the tools that are presented to you. Tons of investors are utilizing revolving credit, whether it is a HELOC. There's scenarios where they're getting a DSCR HELOC on their property, or they are going crazy utilizing business lines of credit and business credit cards. It's what's happening. There's this stigma when it comes to business credit that you're going to burn through the cash, you're going to burn through the cards, you're going to do this, you're going to do that. Yeah, obviously, if you don't have a plan, if you don't have a strategy, but that's with anything. But if you are an investor and you're a smart investor and you're an investor who is taking this seriously and wants to scale, you're coming with a plan, you're coming with a strategy. You're not coming into it blindly. If you do not have a ton of liquid capital, liquid cash, you may have to use revolving lines of credit. We will go a step further. You may have to use a hard money loan. And the hard money loan, it's going to be a loan on the rehab. It's going to be a loan on the purchase price. And the interest rate is going to be way, way higher than if you were to potentially tap into a revolving line of business credit. That's why a lot of investors are using business credit cards for the rehab. I mean, we can go a step further. They're using it, some are buying the whole property, but for the sake of this video, yeah, they're using business credit for the rehab. Because if it's a 20K rehab, a 30K rehab, and this investor has a small business, two small businesses with 100K, 50K in business credit, and the majority of it is at 0 APR, and all the contractors do take credit cards, what do you think is going to be the better strategy? So I just want to just put these things out there just to be more real, just be real with you guys, and just to let you guys know what's going on. So do your research. Now, I mentioned the off-market deals, and that's really where it makes or breaks the capital or if the deal is good or not. If you are looking for investment properties, and yes, you can still find quality properties that are still on Zillow, the Redfins, that are on just retail, but the real deals are going to be off-market, period. You want to find off-market deals. You want to find off-market deals that you can then rehab it, put some appreciation in there, and already walk into a deal and already have a property that appraises higher. You want to have a property that is already going to appraise higher than what you initially paid for it. You want to look for the off-market deals. I think that's one of the first things that you should try to do, is try to connect with a community, a person, whoever that does or knows how to find off-market deals from wherever you live at. If you're trying to invest in a rental that is already listed on the MLS, yes, you can still profit, you can still cash flow, but the margin may be a bit smaller if you found the deal off market. All of the deals that I find are off market, even if it's going to be structured as a conventional or a primary residence. I have an investor where the property was found off market, got a huge reduction, and was then able to get a conventional loan on it. So when this property appraises, it's already going to appraise higher. Appreciation is going to be in there, going to do renovations on it, and now live in it, stay in it for a little bit, and then there's options whether you want to rent it out or whatever you want to do, or stay for it longer, or you can potentially sell it in the long run. But the point is, you have options. And then the last one I would say, you might have to partner up, guys. You might have to partner up with somebody. I know, I get it. You want to do it on your own, yada, 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 yada. Well, it doesn't work like that. Hey, if you don't have that much capital, but you have the resources, you have the contacts, you have the links, this person may be able to bring more capital to the table. Or if you guys just split it and work out a proper contract, set up a multi-member LLC, do all the necessary steps that protects both of you. You know you guys are cool, friends, whatever the case may be, and hopefully you guys wouldn't do anything facetious, but you want to make sure you always structure deals properly. And then the better the deal is structured, it protects you guys, and that's also how now, when it comes to tax time, you'll have a better write-off in the future. So I can go on and on about that one, but look into partnering up with somebody. Well, maybe it is going to be a scenario where, hey, let's go into this 50-50. I can't do this on my own. I can't scale on my own right now. But you know what? If we can partner up on 2 to 3 deals, I can generate enough capital that, you know what, on the 4th one, I can continue on my own. Or that person continue on their own. And then maybe you guys join forces on another one, or even on a bigger scale. Maybe a scenario where, hey, let's join forces on these single family homes. But then as it continues to grow, you guys continue to do your own thing solo. You come together again, and now you want to work on an 8 unit, a 10 unit, want to work on a 20 unit apartment building. There's just so many different factors. But the point of this video and the point of this whole thing is there's options. So that's the biggest takeaway. But like I said, I don't want to make this video longer than it already is. We're going to wrap here. And if you want me to go more into this, please just let me know, drop a comment. I definitely will. So we got more on the way. Let's go.